If you asked me for the single most misunderstood word in finance, I would not say inflation. I would not say leverage. I would not even say diversification. I would say safety, because most people use that word carelessly. They see a bank logo, a debit card, an app that opens instantly, and a balance that looks stable, and they tell themselves their cash is safe. But a number on a screen and access to money are not the same thing. A guarantee on paper and usable liquidity in real life are not the same thing. And that distinction matters a great deal more than most people realize when a financial system moves from calm to stress. If I were speaking to an ordinary American household right now, I would not begin with the stock market. I would begin with the money they believe is untouchable. The money in checking, the money in savings, the money parked in one familiar institution because it has always been there and because nobody around them has ever given them a reason to question it. That is the money I would want them to examine first. Not because I think every bank in America is about to collapse, not because I think people should panic and empty their accounts tomorrow morning, and not because I enjoy dramatic predictions. I do not. I prefer simple arithmetic to dramatic language. What concerns me is something more specific. The system underneath the average bank account is more fragile than the average depositor understands. And the time to think about that fragility is before you need to test it, not during it. I have lived long enough to watch intelligent people confuse convenience with safety over and over again. They believe money is safe because it has been easy to reach in normal conditions. Then one abnormal condition arrives, and suddenly they discover that their access, their timing, and their assumptions were all depending on the uninterrupted smoothness of a machine they never took the time to understand. The machine usually does look smooth until it does not. Years ago, I watched a perfectly sensible man lose more peace of mind in one weekend than he had lost in the previous 10 years. He was not a speculator. He was not chasing strange assets online. He had simply kept too much cash in one regional bank because he liked the staff, liked the branch manager, liked the website, and had never been given a reason to consider that ordinary comfort can become a weakness. When rumors about the bank began to spread, he did what people always do in those moments. He told himself not to overreact. He waited. Then he tried to move funds. The transfer was delayed. Customer service was overwhelmed. The news worsened. Nothing catastrophic happened to him in the end, but I remember what he said afterward. He said the worst part was not the financial risk. The worst part was realizing that something he thought was passive had become active all at once. That is an excellent way to put it. A bank account feels passive until stress turns it active. Then suddenly you care about settlement timing. You care about insurance limits. You care about whether a transfer clears before a weekend. You care about whether the institution itself is strong, whether the regulators are prepared, whether depositors are nervous, whether markets are liquid, and whether your life can continue smoothly if access becomes slower, messier, or more uncertain than you expected. That is not a fun list, it is a necessary one. So let me give you the principle first. If part of your survival depends on immediate access to purchasing power, that portion of your money should not depend entirely on one bank remaining calm, liquid, and unquestioned. That is the principle. The implementation is simpler than people think. Most families do not need to abandon the banking system. They need to stop trusting it in the lazy, concentrated way they have been taught to trust it. Now, the reason I take this seriously has nothing to do with superstition and everything to do with structure. A bank is not a vault in the way people imagine it. It is a leveraged institution. You deposit money. The bank uses those funds in a broader asset, liability machine. That machine includes loans, securities, funding assumptions, liquidity management, and confidence. Confidence matters more than most depositors understand. A bank can appear fine right up to the moment enough people begin asking whether it is fine. That is one of the peculiar truths of banking. A strong bank must manage assets and liabilities intelligently. A weak bank may survive for quite a while if nobody presses on the weak points all at once. But once depositors become nervous in the age of mobile transfers, the timetable compresses violently. That is what the public learned in the banking scares that surfaced not long ago. Not because the public suddenly became experts, because speed changed. In an earlier era, a bank run involved lines, paper, branches, and delay. In this era, a bank run can begin with smartphones, group chats, online dashboards, and a frightened set of depositors who can move enormous sums before lunch. People still talk about bank runs as though they belong to old movies. They do not. Technology modernized them, and whenever speed increases in a fragile system, caution deserves a premium. Now, one mistake I do not want anyone to make is to hear this and immediately start thinking in slogans. All in cash outside the bank, all in gold, all in treasury bills, all in one brokerage. That is not how I think. When a problem is structural, I want several layers of resilience. Not one dramatic gesture. I want insurance limits respected. I want liquidity diversified. I want some direct government paper where bank risk is removed. I want some immediately available cash outside the digital rails. And I want the size of that outside reserve to be tied to life, not to fear. That last part matters. People get themselves into trouble when they build plans around emotion instead of around operating needs. So let me say plainly what I believe the ordinary household should focus on before April 2026. Not every dollar, not a theatrical amount, a strategic amount. I believe every household should have roughly 3 to 6 months of true living expenses positioned outside ordinary bank deposits, outside the bank deposit structure itself. That means not sitting entirely in a checking account and not being dependent on one institution, one branch, or one app. For some families, that may mean $15,000. For some, it may mean $30,000. For some, it may mean more. The number is not universal. The principle is you are not trying to hide from the financial system. You are trying to avoid becoming completely dependent on its smooth operation during a period when several parts of that system are under more pressure than the public has been encouraged to understand. Now let me explain why the pressure is real. The first layer is the bond portfolio problem inside banks. This is one of those issues that sounds technical until you understand how basic it really is. Banks bought large amounts of long duration securities when rates were abnormally low. When rates rise sharply, those bonds lose market value. If the bank can hold them and funding remains stable, the losses may stay unrealized for a while, but the losses still exist. That distinction between visible and invisible is very important. Finance contains many problems that are invisible right up until the moment they become urgent. A bank can report stability while carrying a portfolio that would look much less reassuring if it had to be marked under pressure. That is what frightens smart depositors. Not that every unrealized loss becomes a disaster, but that an unrealized loss becomes a disaster when it meets liquidity stress. The public tends to hear the word unrealized and assume it means imaginary. It does not. It means unrecognized in full. That is a very different thing. The second layer is commercial real estate. I have said for a long time that people underestimate how slow real estate problems can be in the beginning and how fast they can become obvious later. An office building does not collapse because one headline says vacancy is high. It weakens lease by lease, renewal by renewal, refinancing by refinancing. At first the owner extends and hopes. The bank extends and hopes. The market narrative extends and hopes. Then eventually the loan matures into a rate structure or valuation environment that no longer supports the old assumptions. That is when hope turns into math. And math is less forgiving. The trouble is that many regional and mid-sized banks are close to exactly these kinds of exposures. Not because they are villains, because that is the nature of their business model. They are close to local property, local lending, local business conditions, and local depositor sentiment. That can be a strength in healthy times. It can also become concentrated fragility in unhealthy times. So if you already have banks carrying bond losses and you add commercial real estate stress that has not fully surfaced, you now have two pressure points leaning on the same general part of the banking system. The third layer is government debt and liquidity withdrawal. This is the part almost nobody explains clearly to ordinary savers. The government has to borrow heavily. Those borrowings have to be absorbed. If foreign demand is less dependable, and the Treasury keeps issuing in size, the domestic financial system ends up absorbing more of the load. At the same time, liquidity conditions can tighten instead of loosen. That combination drains oxygen from the rest of the system. When the government competes aggressively for savings, less is left for private credit creation, private refinancing, and the speculative edges that only function well when money is abundant. People look at the broad market and say it still seems fine. That is not the right test. The right test is whether the plumbing is becoming more strained, because systems usually fracture in the plumbing before they fracture in the headlines. Now let me tell you something important about deposit insurance, because here the public swings between two bad extremes. One extreme says do not worry at all. Deposits are insured. The other says the insurance means nothing. Both positions are lazy. Insurance matters. It matters a lot. But insurance is not the same thing as frictionless access in a broad stress event, and that is where adults should make their distinction. If you have more than the insured amount sitting in one institution without having thoughtfully structured the accounts, you have a concentration problem that should be solved. Immediately, not debated, not postponed, solved. But even if you are fully within insurance limits, you can still have a liquidity design problem. If every dollar you need for today life is trapped inside the exact channels that become congested when anxiety spreads. That is why I keep returning to the same practical advice: 3 to 6 months of living expenses outside ordinary bank deposits. Because the issue is not merely final recovery of funds, the issue is operating freedom during an ugly window. In every serious financial disturbance, there is a period where the public mood is worse than the resolution mechanism. That period can feel much longer than it is. A family with outside liquidity can walk through it. A family without outside liquidity may not be ruined, but it can be frightened into bad decisions precisely because it has no calm buffer. That calm buffer is worth a great deal. It prevents forced selling. It prevents expensive borrowing. It prevents emotional mistakes at the exact moment. Emotional mistakes are most common. Let me tell you what I would not do. I would not withdraw everything and stack bills in a closet like a frightened amateur that solves one problem and creates several others. I would not hold my entire reserve in any one form. I distrust all or nothing behavior because it usually comes from panic, not thought. And I would not mistake a brokerage account for perfect immunity either, because many people simply move concentration from one box into another without understanding the plumbing they are still relying on. What I want is layered access, a small amount of actual cash for immediate disruption, a larger amount in short-term treasury bills held directly where feasible so bank-specific balance sheet risk is removed from that portion. Possibly some physical precious metals if the household understands what they are for and what they are not for, and then bank deposits structured intelligently across institutions and account types instead of lazily piled into one familiar place. That is a much stronger design than the default setup most people drift into. Now let us talk about April 2026, because the date itself matters less than the sequence around it. I am always suspicious of precise dates in finance when they are used as theater, but I respect them when they are used as deadlines for preparation. Preparation needs a date. Otherwise, people postpone it forever. By the time a problem is obvious, every action becomes harder. Transfers get crowded. Emotions get louder. Advice gets worse. The public becomes reactive instead of deliberate. So I like the discipline of saying this should be done before April 2026. Not because I believe the clock strikes midnight and the world changes in an instant. Because I know how human beings behave when they think there is still time. They drift. Drift is expensive in finance. That is why the household that prepares in calm weather almost always looks excessive right before it looks prudent. Now, there is another part of this that many people miss. The amount outside the bank should not merely match fear. It should match the time you need to function without begging the system for immediate cooperation. That is why I said 3 to 6 months. A week of groceries is not enough. One weekend of cash is not enough, but neither is a wild, theatrical withdrawal of every savings dollar. The right amount is enough to let you continue living, paying core obligations, and staying rational while the financial world goes through the sort of noisy uncertainty that causes less prepared people to freeze. I find that approach far more intelligent than either complacency or panic. Now let me give you the mental model I would want every family to carry. There are three categories of money. There is operating money, there is reserve money, and there is long-term capital. Operating money is what runs the month. Reserve money is what protects the month. When ordinary systems stumble along, term capital is what should be invested for growth, not parked nervously in checking. The public blends these categories together, and that is where trouble begins. They invest reserve money that should have stayed liquid. They leave long-term capital in idle deposits earning too little, and they keep operating money, reserve money, and excess balances all in one bank simply because nobody ever forced them to think. That is sloppy capital allocation. A family deserves better than that. So I would separate them, keep operating money in the bank or banks you use most, keep reserve money partly outside ordinary bank deposits, and keep long-term capital invested according to a structure that fits your age, your risk, and the kind of economic regime we are actually in, not the one people nostalgically remember. That separation alone solves many mistakes before they happen. Now, because people always ask, let me address the exact forms. Physical cash has a role, a limited role. Its virtue is immediacy. Its weakness is that it earns nothing, can be lost or stolen, and is not a long-term strategy. Treasury bills held directly have a very different virtue. They remove bank-specific exposure from that slice of your liquidity and give you yield while you wait. Their weakness is that they are not the same thing as a bill in your hand when a local disruption happens. Gold has yet another role. It is monetary insurance, not grocery money. People confuse those roles and then complain the asset did not behave like the asset. They never bought it to be. A bank deposit has convenience. A treasury bill has sovereign exposure without the bank as middle layer. Physical cash has immediacy. Gold has independence from the promises of the system over longer arcs of stress. Each has a place. None should dominate thoughtlessly. This is why serious people build layers. Now let me return to the underlying danger, because it is not just any one bank. It is the combination. Banks with embedded losses, commercial real estate with delayed pain. Government borrowing that absorbs system liquidity. A public that still thinks 2023 was a contained incident instead of a warning about speed. And depositors who have been trained to believe that because their app works on a normal Wednesday, their money architecture must be intelligent. That training is dangerous. The purpose of a financial structure is not merely to look smooth in normal conditions. Its purpose is to preserve your options in abnormal conditions. I care a great deal about options. Options are what stop a temporary disturbance from becoming a forced error. If you have operating money, outside reserve money, and long-term capital properly separated, you can respond to stress without doing anything stupid. If you do not, then every disturbance pressures the same pile of money, and suddenly the household becomes vulnerable to emotion. Emotion is expensive in a crisis. People sell the wrong assets, borrow at ugly terms, move too late, move all at once, trust the wrong reassurance, believe the wrong rumor. Every one of those behaviors becomes more likely when no buffer exists between daily life and financial turbulence. A reserve outside ordinary bank deposits is not merely about access. It is about psychology. That is one reason I care about it so much. Good financial design does not only improve returns, it improves behavior under stress. And behavior under stress often determines outcomes more than forecasts ever do. There is an old habit in finance where people assume intelligence means predicting the event exactly. I do not think that is the heart of it. The heart of it is building a position that can survive several plausible versions of the event. If nothing dramatic happens, a properly structured reserve still serves you. If a regional banking problem flares up, it serves you. If transfer rails get crowded for a few ugly days, it serves you. If a larger liquidity event appears, it serves you. That is what I mean by robustness. I have always preferred robust design to clever drama. Now, Some people will say that if the government and the central bank intervene again, why worry? Because intervention and convenience are not the same thing. Because official support can stop collapse while still leaving ordinary people navigating messy days or weeks. Because guarantees can be expanded while trust is still dented. Because the existence of a backstop does not mean you should volunteer to test the backstop with all your operating liquidity. And because the point of preparation is not to make a moral statement against the system, the point is to avoid being dependent on its perfect functioning during its sloppiest moments. That is a modest, intelligent objective, not a radical one. Let me go even further. I think many people misunderstand what it means to be conservative. They think conservative means leaving everything in the bank and avoiding visible volatility. That is not conservatism. That is habit wearing a polite suit. True conservatism asks a different question. What structure gives my family the highest probability of preserving access, purchasing power, and emotional stability across a range of unpleasant but realistic outcomes? That is a much better question. It may lead you to some bank deposits. It may lead you to some treasury bills. It may lead you to some hard money outside the system. It may lead you to lower concentration and more planning, but it will not lead you to laziness. Laziness is never conservative. It is simply unexamined. Now let me tell you how I would explain this to a retiree, because retirees are often the people most hurt by sloppy liquidity design. A retiree does not merely need eventual recovery. A retiree needs regular access. Bills continue. Medication continues. Insurance continues. Life continues. That means the reserve question becomes even more important. A younger family with high income may survive a messy week through future earnings. A retiree, depending on the portfolio and cash flow, does not have that luxury. So for retirees, I would be even more serious about this segregation. Enough immediate funds, enough outside bank reserve, enough short sovereign paper, and no careless concentration in one institution simply because it has always been there. Routine can be one of the most expensive forms of trust. Now, if I were forced to reduce all of this into one sentence for the title of a legal pad, it would be this: withdraw enough from your bank before April 2026 so that a banking disruption becomes an inconvenience instead of an emergency. That is the sentence, not empty everything, not hide from the world, not guess at apocalypse. Withdraw enough so that you remain in control if the system becomes temporarily less cooperative than you have been trained to expect. For most households, that means 3 to 6 months of true expenses placed across more resilient channels. And if your balances exceed insurance limits in one institution, correct that immediately as a separate issue. Now, because I always prefer action to abstraction, here is what I would want a family to do this month. First, list every bank and every account. Second, calculate the true insured exposure by institution, not by vague feeling. Third, calculate 3 months of essential expenses, and then 6/4. Decide what portion of that reserve belongs in physical currency, what portion belongs in direct short-term government paper, and what portion can stay in diversified bank channels. Fifth, execute the structure before you need it, not after another round of frightening headlines. Before, there is a tremendous advantage in doing calm work while the public is still relaxed. It costs less emotionally, it costs less financially, and it usually leads to better decisions because you are not negotiating with fear. That is what preparation is. Preparation is not prediction. Preparation is respect. Respect for the speed at which banking stress can travel. Respect for the difference between insured and accessible. Respect for the fact that a money architecture built in easy conditions may not be robust enough for harder ones. And respect for your own household, which deserves better than being dragged into last-minute improvisation because nobody wanted to do boring work in advance. I have made a great deal of money by respecting boring work. Most people think big results come from dramatic acts. Sometimes they do. Often they come from thoughtfulness applied early, before the crowd understands why the thoughtfulness mattered. This is one of those cases. If the system stays calm, your structure is still better. If the system gets noisy, your structure may feel invaluable. That is an excellent trade. I would much rather look slightly overprepared in a calm month and discover in a bad week that I was confusing habit with prudence. So no, I would not tell people to pull every dollar out of the bank, but I would absolutely tell them to withdraw a strategic amount before April 2026. Enough to live, enough to breathe. Enough to avoid becoming a hostage to transfer delays, institutional stress, public panic, or the dangerous illusion that because a balance appears on a screen, your money architecture must already be wise. Wisdom is not what appears on a screen. Wisdom is what still works when the screen stops feeling comforting. That is what I would build for, and that is what I believe ordinary families should build for now.